When it comes to gold exposure ETFs, there's two that come to mind. One of these ETFs is offering a 51% yield that sounds like an absolute cheat code, while the other is sitting at a steady 12%. But most investors are walking straight into a slaughterhouse. One of these numbers is an optical illusion, designed to drain your principal, while the other is using a hidden, synthetic strategy to protect your wealth. In this video, I'm pulling back the curtain on the actual total return to show you which one is a trap and which one is the ultimate winner as an income machine. Before we get started, I do want to put out a disclaimer that nothing in this video is financial advice. Please do your own research. Investing comes with risk, including loss of capital, and always consult with a financial professional. So the top two covered call ETFs that have gold exposure are GDXY, which I actually covered on another video here. Make sure to check it out, and IAUI. So I'm going to do a comparison of those two and tell you which is the clear winner. So in the other video where I put my emphasis on GDXY, one of the main challenges that I saw in it is that in spite of its massive 51% yield, it's that it really is just liquidating your own investment and handing it back to you. Let me give you a fun overview from YieldMax website. The key takeaway from this is that it's an ETF that's generating weekly income by selling call options or call spreads on GDX, and it's providing participation in the share price appreciation of GDX. One thing that I want to make clear is that GDXY doesn't own physical gold. It also doesn't own shares of gold mining companies. It uses a synthetic long position to mimic GDX's gold miners ETF, and then sells covered calls against that position to generate that massive cash flow that you're seeing. And if you're wondering what a synthetic long position means, let me explain that.
And please, speak as you might to a young child or a golden retriever.
So a synthetic long basically acts like it owns the stock without actually buying it. So if GDX goes up, GDXY synthetic position goes up as well, but it uses less cash. It lets them run option income strategies. They can pay higher yields. Let me illustrate what that would look like with actual numbers. So let's say a stock is $100. If you were to buy a call and sell a put, both at the same strike price of $100, and same expiration, that is what a synthetic long is. So the bottom line is that GDXY is structurally capped. It generates high yields by selling call options on GDX, but there's a trade-off. So in exchange for that massive income, the premium, the fund gives away the upside potential of GDX above a certain price, and that is why I mentioned it's capped. So if GDX goes up, let's say 20%, GDXY will likely only move up a fraction of that before hitting its ceiling. And then of course there's the NAV erosion. NAV stands for net asset value, and in funds like GDXY, it's not just price going down, it's a structural decay caused by two main factors. So the first one is asymmetric return trap. So GDXY is capped on the upside, but it's fully exposed on the downside, and it suffers from a one-way erosion. So let's say that GDX drops 10%. GDXY would drop roughly 10% too. Of course, minus that small cushion of the option premium. But let's say GDX rises 10%, GDXY might only gain 3% because the sold calls capped the rest of the gain. And there's a math problem because over time, the fund fails to recover its losses during rallies, leading to a stair-step pattern downward in share price. And then the other main issue is the destructive return of capital. So YieldMax's funds often target a specific payout. If the option strategy doesn't earn enough to cover the dividend, The fund may actually pay you back with your own money to keep that high yield. So I'm going to transition now to IAUI, which is the Gold High Income ETF. And this one deserves a lot of attention right now. And I'm going to point out some of the key factors and what makes it a better option if you want gold exposure. IAUI actually tracks the price of the gold bullion via gold ETFs like GLD, not the miners. It's a pure play on the metal itself. Here's the secret sauce. Instead of just selling calls and capping all your gains, IAUI uses a data-driven option strategy, and this gets me really excited. They use Section 1256 contracts, which are tax advantaged. So here's the upside. Unlike GDXY, which often hits a ceiling, IAUI is designed to protect the NAV and allow for more upside participation. So you essentially get the gold rally plus a distribution rate of around 12%. Check the charts. GDXY often suffers from the destructive return of capital. That's when the fund pays your own money back just to keep the yield high, which kills the share price over time. IAUI, on the other hand, is managed by the same team behind SPY, which I covered on another video, and they focus on tax-efficient income. They want the NAV to stay stable and grow with the gold, not melt away like a popsicle in the Sahara. So here's the bottom line. If you want to speculate on the volatility of mining stocks, then yeah, go with GDXY. But if you want real gold exposure with a tax-efficient 12% yield that does not destroy your principal, IAUI, in my opinion, is the clear winner for this income machine. Thank you so much for watching. The focus of the channel is to talk about covered call ETFs, and my goal is to put out a piece of content every single week. Thank you so much. Have a great and prosperous week.